When you sit down and take a good look at your stock portfolio and you notice that values are accelerating in a way that looks like it's going vertical, and while sitting there, you notice that the marketplace appears to be somewhat complacent, maybe you need to take another look at your stocks. The problem is that when you mix price acceleration with vertical performance and complacency, the market has a tendency to change its mind. One of the unwritten rules that I adhere to is that the market likes to punish the most investors that it can. That's why sell-offs are so fast and unpredictable. Greed has set in, and the market is simply lying in wait for just the right time when no one is paying attention. And then, all of a sudden, the trapdoor opens, and before you know it, you're down 5, 10, 15%, even before you know what to do. The opposite is also true. It's as if you're just convinced yourself that the selling will never stop, and the market realizes this and turns up when your confidence hits absolute zero. In my opinion, we are near the point that greed has set in and people are afraid of missing out. That means the formula for the market to punish is nearly set. So let's take a look. A Bank of America global research report recently published has detailed how their bull and bear indicator, as you see here, would need to hit a signal of over 8 to trigger a sell. For this to happen, there needs to be at least $20 billion of inflows into risky assets by mid-February. Among other circumstances, B of A wants to see new highs in high-yield corporate bonds versus U.S. Treasuries and a mix of other bullish positionings. So, with the B of A bull and bear indicator currently showing a level of 6.5, which is the most bullish since March 2018, it's not yet extremely bullish or at a measure of 8. According to B of A, the peak bullishness could be realized after the signing of the trade deal with China on January 15th and the FOMC meeting on January 29th. So, according to B of A, you want to mark your calendar for the end of this month. For another perspective, let's turn to Lance Roberts of Real Investment Advice. According to Lance, the market is nuts. So, what is nuts exactly? The way Lance sees it, the overbought, extended, and complacent market is heading toward a day of reckoning. This first chart from Real Investment Advice shows the near vertical price acceleration, which is a hallmark of the kind of melt-up that takes place near the end of the cycle. Lance also pointed out that when markets get more than 2 standard deviations above their long-term moving average, reversions tend to hit stocks shortly thereafter. Lance believes that both factors are in play here. On top of that, the put-call ratio, which is the number of put options being bought on the S&P 500 versus the number of call options, is now hitting historical levels and showing an increasing appetite for risk. Now looking at this next chart, the upper portion is the relative strength index showing a rise to previous extreme levels. The middle and lower portions show the put-call ratio also nearing extreme levels. So while none of this means the market will crash, Lance Roberts said it does suggest the risk-reward ratio is not in favor of the bulls short term. Roberts is in agreement with fellow money manager Doug Cass, who also recently raised the alarm to clients with his not-so-rosy outlook. Cass stated, "It's growing increasingly clear to me that global stock markets are in the process of making speculative moves, driven by global liquidity, that may even compare to the advances that culminated in the seminal market tops of the fall of 1987 and in the spring of 2000. Now, in my opinion, that might be a bit extreme here. Nonetheless, Robert says investors are getting swept up in the fear of missing out, or FOMO, and ramping up their risks despite the fact that every valuation measure out there is topping out at extreme levels. Roberts thinks this is nuts, which is why he took profits out of his portfolios. Specifically, Roberts raised cash by selling off shares of Apple, Microsoft, United Healthcare, Johnson & Johnson, and Micron. Roberts also scaled back overweight holdings in various ETF sector plays such as the technology select sector and the healthcare select sector. According to Roberts, while the stock market could continue higher, at least in the short term, based on the Fed's ongoing liquidity injections, the gains for 2020 could very well be front loaded for investors. Taking profits and reducing risk now may lead to a short term underperformance in your portfolios, but you will likely appreciate the reduced volatility if and when the current optimism fades. So, take your chances. For me, I'm still sitting on the sidelines. Again, I have about 3/4 of my money in the market, and I'm waiting to deploy the other 25%, but I'm going to wait for the opportunity, and I don't quite see it yet. But for today, that's ChewDog Charts. Thank you.